Welcome to Bar Charts Market and Close. I'm your host, John Rowland, Bar Charts Senior Market Strategist. And I don't know about you, but it certainly feels like this week was like a visit to Six Flags, a roller coaster ride up and down. I'm going to give you my thesis for the worst case scenario for the S&P. We'll look at a hypothetical in oil. Is there value in some of these U.S. companies that have been beaten down by the Chinese relationship? And all that, plus your questions. And to help me with today's session, as always, my co host, Mr. X, Thomas. Hello, Thomas.
Hello, John. What a week, huh?
Woo! Unbelievable. I tell you what, and we're going to talk about this, but in my 40 years, this was the wildest I've ever seen it. And let's just leave it at that.
It's I mentioned this to you, John. It reminded me, unfortunately, of the days of the global financial crisis. Just bloodbath after bloodbath, no end in sight. Hopefully, it doesn't get that bad, but we will explore that idea today. John, just a quick reminder for everybody watching the show directly on our website. If you guys want to ask a question, and I'm sure you do, go ahead and click Ask a Question at the top right. You'll see it in the orange color. And then if you're watching on YouTube, just go ahead and ask those questions directly in the chat, and we will get to as many as possible. All right, John. So this has been a challenging, very challenging 2-week period for a lot of people. S&P, NASDAQ, Dow have all suffered some of their worst days in multiple decades, John. And it sort of begs the question, should I buy here because it represents an incredible opportunity, or is the rug going to get pulled out from under me, John? And what I mean by that is, how far could the stock market drop? And for the answer to that, John, we turn to you and your sage advice, please.
Okay, so let me start by saying that I'm going to present a thesis, or at least the basis of my discussion is going to be revolve around this white paper that I read back in October of 2013. This is by Reuters, and it's called The Great Monetary Experiment. It's about the quantitative easing and the prolonged period of near zero interest rates. Yeah, and again, this helped stabilize, economic and financial conditions back during the GFC, as you kind of mentioned. Banks, government rescued banks. We ran up large fiscal deficits. The manipulation of interest rates and monetary supply. And so my thesis is that the experiment is over, and that the Fed at this point can't cut rates to near zero because they will risk hyperinflation. So what I did was here is to start with is I'm looking at a monthly chart that goes all the way back to the great financial crisis. As you can see right back here. And I did a Fibonacci extension based on that and our current all-time high. So if we look at this from just this perspective, right, what we can see is, let me go and make this chart a little bit wider. What we can see here is that the first level of support based on the Fibonacci would be at around 40.50. Now, that's at the 38.2% level. That's usually a very good level for a bull market to hold. So, as bad as everything seems in the big picture, it's not so bad. 50% would be below 3,500. And I would say the worst case scenario would put us down at that 61.8, which is around the post-COVID lows, around 2760. Now, if we think about that, that is also the time in this great experiment of another heightening of fiscal liquidity. So that would make sense. If the liquidity came out of the market, that is where we could fall back to. Now, let's look at this chart. Now, before I go to a smaller time frame, I just want to show you one more level that I didn't turn on for this demonstration, and that's the 3.23, which is actually another very strong bull one that you typically hold. And notice what happens when I turn that on. It is literally the dead low of this week's or this month's candle. So let's go down to a lower time frame, weekly. And um, what I want to kind of show you here is that this purple line down here, 4190.50, represents a cluster of Fibonacci extensions from this most recent downtrend. And we've kind of looked at this in the past couple of past sessions. But in terms of a fundamental aspect, if we looked at forward PE and we looked at earnings of the S&P, that would put the PE for PE somewhere around 15, 17x. And that historically is where you find value in the S&P. So again, I think in my world, if I had to say what is the worst case scenario, and other things got worse from current levels, then I would say that's kind of where I think the market would go to. But Thomas, I wanted to kind of show you something here is, do you remember this little configuration, or this little candle configuration that we had that happened back in September of 22? Do you remember that?
It's ringing a bell, John. I think it was named after a certain Fed chairman, if I remember correctly.
We called that the Powell hammer, and that was when Powell said that there was going to be a change in monetary policy. So again, makes a lot of sense. If the market is going to return to the scene of the crime or the beginning of the experiment, that might be a great level. And I did say at the time that how important this level was going to be in terms of making for resistance, which we see multiple times, and then it could be support. It is kind of ironic now. We're 3 years later, and now the Powell hammer has come back into that discussion. But certainly, Thomas, if we get down to these levels, somewhere between the 4190 level and that 4050 level, I think you'll find a lot of bargains in the S&P.
So, John, let me ask you, if it did end up falling that low, how, I know you're probably going to buy some there substantially. What would your, let's say, conviction rate be to make a buy?
Yeah, I think at that point I would probably be all in on, my asset class allocation. Probably 75, 80% in equities, but I'd be all in. There'd be no holding back at that point.
All in, folks. You heard it.
All in. Push the chips.
All right, John. So, one of the things, John, that I love to do, I love to track earnings events. I love to see, what stocks are doing when they have these, either negative results or positive results. And when it comes to positivity, one thing I like to do, and people who follow us on the X account, John, I like to call out God candles.
Mm-hmm.
And that is when you have to extend your neck upwards, John, to see how far the stock has shooted. Now, John, I like to call them God candles, but I think there's actually a technical name that people refer to these as. And for that, what do you say?
Yeah, it's called a Marabusu. I think that's what, my Japanese isn't like that great, but yeah, these are large body candles that show no wicks or shadows, or it has very small shadows. And this is an indication of a strong market momentum in one direction. Now, in this case, we see a big green candle. You can see it's right here, right there. And this is really a sign of strong buying pressure. And this is a very bullish signal. Now, ideally, it reflects the momentum or the indication of a continuing trend or a strong trend. Now, we don't have that, right? But it can also be a signal of a reversal pattern. So I want to talk to you about recognizing this candle, and that there are some rules and observations that you can make. And we'll talk about how we can actually trade this. But then I want to give you a caveat as well at the end. So if we're in a continuing trend, what you want to kind of look for is after the Marabusu is you might see a gap and go, or you might see 3 to 5 little birds, little teeny candles, before you get another explosive move. Now, in reversal patterns, they typically come after periods of consolidation. Now, we didn't really get a consolidation here, but we did see a large range of price up and down. So we'll give it the benefit of the doubt there. Now, all Marabusos should be confirmed with volume. And then if I turn volume on, so I can't do it with the index because this is not actually traded. But if you look at SPY, and I would recommend that you do this process on your own, you'll see that we've had double or triple normal volume. I think you can back me up on that one, right, Thomas? So, anyways, the risk in the Mariposa is if price falls. In this case, this is a green one. If price falls below that green, so you take the trade in the direction of the Mariposa. In this case, since we have a green candle, we'll be looking for a bullish or bull opportunity. Now, you can add other technical analysis to help you confirm it. And so one of the ones that you can start thinking about is MACDs and RSIs. And let me put, here we go. Let me put that up. And we'll come back to this in a second, Thomas. So the other thing we can look for is engulfing patterns, or we're finding where a collection of candles, of maybe two candles, and an engulfing pattern. We didn't really get that. Now, all candlesticks, candlestick theory, the higher the time frame gives you, or the pattern gives you an increase of significance. In other words, confidence. So there is a rule we can use, which is called the 50% rule. And the 50% rule says that if we draw back into the candle, we'll look for entries at or about the 50% of that candle. Now, if it holds above, then we just wait for price to get above the Mariposa. Now, we do have a tool. We do have a 50% tool. There it is. It's found over here. You can see it there. And I've already drawn it, and that the 50% line is represented by this purple line right there. Now, if we pull back, or market falls back into the candle, but it falls to the 50 or below the 50, then what we can do is we wait for it to recapture the 50. Now, the importance here is that we want to make sure we confirm the retracement and the resumption of the price action. So again, we might look for some bullish type candlesticks, or even, for instance, like some bullish reversals. Now, those typically can be found in lower time frame. So if I go to a 30-minute time frame, and there's our purple line right there, you can kind of see one right here. Right there would be one of those bullish engulfing candles followed by a doji. And, notice how we did get a retracement here yesterday. And then I think this was today, or at the end of the day yesterday, you did get another opportunity. Now, if you wanted to be a little bit more aggressive, you could wait until you clear the candles that created the retracement, which would be right here. So you probably got on the late day signal today. So that's how you could trade the Mariposa. And I think if you go, like, let's say Google or Apple, you will see a lot of these candles were made in a lot of the stocks today. A lot of the opportunities have passed, but some of the markets still have those opportunities. So I would encourage you to go look at. And again, go and look at what happened when the SPY, which is a traded asset, you will see how important that 50% line was. So let me give you one caveat on this one, Thomas, and that is that in retracements and on the retracement days, if we have a news story or a collection of news stories, or we have an uncertainty around some news stories, which is certainly where we're at today, you might want to be a little bit more cautious. In other words, wait for some greater confirmations. Now, again, let's go to our daily. And so what I was talking about, the RSI here, so we got them from an oversold condition. And then that's where we broke out, and that's kind of where the Mariposa. That would be a positive sign, but we haven't gotten back above 50. To me, that would be an important sign of a potential uptrend, the RSI getting back above 50. And notice that our MACD has yet to cross over. So we're not getting a confirmation on that, and that's kind of the caveat I wanted to give you guys, all right?
Well, thank you, John. For simplicity's sake, I think I personally am going to continue to refer to these as God candles because I for sure am going to misspell that if I tried. But I appreciate the technical breakdown of that.
Well, next time you're in the sushi parlor, right? You can just say, "Hey, throw me down a Mariposa piece of tuna there."
All right. So, John, stocks have certainly been a victim of the recent trading activity, but they're not the only ones. Crude oil has taken it on the chin. And the reason we're going to do a segment on this, John, is I saw an interesting headline. Now, our friends, in quotations, our friends from over at Goldman Sachs put out this warning, John. They say that in an extreme scenario, crude oil could plunge below $40 a barrel. John, is that even possible?
Anything's possible, Thomas, and certainly in oil. Again, I want to laugh about and talk about extreme volatility. I would never have thought that a oil futures or any futures contract would trade below zero. Well, you only have to go back to 1920. Excuse me, not 1920, 2020, 1920, to see that happen. So let me pull up this. All right, so here is crude oil. So one of the things about crude oil markets is that it's very prompt to rebalance a production supply during price changes or volatile price changes. Again, this is kind of that. There's that sell off that I never thought we'd ever see in the zero. But let's go to weekly within the last, let's say year or so. And so in the world of crude oil here in the U.S., the estimate range of cost for production for a new barrel of oil is somewhere between $60 and $65. Now, shale costs more, and Permian Basin, which is out in Texas, if you've been watching that movie with Billy Bob Thornton, that's where Permian Basin is. It's a little bit cheaper. So if price fell below $50, Thomas, production would drop precipitously in that you would see a reduction of over 1 million barrels per day within 12 months. Now, at $65 a barrel, shale production, that's like in areas like in Pennsylvania, will remain flat. But here's the kicker, Thomas, that shale whales production decreases 60% within the first year. In other words, diminishing returns the moment they pipe the well. That means drillers need to drill to maintain production. But they're not going to drill if it's below $65. So the question really becomes now is this a vulnerability to U.S. production or is this a backstop to price? Only time will tell. Now, could we spike down to $40? Yeah, maybe something a black swan event I can't think of or right off the hand, but I think it would be very, very short-lived.
All right. I tend to agree, John, but it would sure be exciting if it did. Huh?
Well, let me give you one more added feature. You know how I'm always bullish about natural gas, and that would be that about 30% of all natural gas production is a byproduct of oil production. So, and this is going to be a crazy thing to say, but if we do see a decline in crude oil prices where we see a limited amount of new production, that is going to be extremely bullish for natural gas because I think natural gas demand has become very, very inelastic.
All right. So, John, let's go back to equities and talk about a stock. I have been tracking this stock for a long time, John, and I'm just sort of blown away by the magnitude of the selling that we've seen. And it's a stock I grew up with. I mean, I bought their products all the time, John, their shoes, their clothing, their accessories. And that, of course, is Nike. And I've been wanting to talk about this for a while, John, just to sort of get a TA breakdown. Nike caught my attention within the last week, and it's not just for their prolonged sell-off. It's because one of their board of director members, his name is Robert Swan, he made an insider buy, John. He bought over $500,000 worth. Now, if you're not familiar with Robert Swan, he was the former CEO of Intel, John, and then he came on the board of directors of Nike. So smart guy, successful guy, made an insider buy. Nobody forced him to. And we always said, John, there's a lot of reasons to sell, but only one to buy. Bob Swan is buying. John, do you think Bob Swan made a smart decision here?
Well, I mean, um, certainly Nike has been one of these stocks that is a basket of stocks that have been punished by the relationship or their exposure to China. And here I'm sorting by 1 month return, and you can see Nike is at the top of the list. So maybe there is value in it. And again, this is what you were talking about. If we go into our insider trading page, there is Mr. Holmes. He bought 8,600 shares. And now he has about 33,000. So, I mean, that's not a lot of shares, really, if you think about it, and $500,000. But it did show that it was an increase of about 30% of his how many shares he does hold. So I think you're right. I think there's some validity to it. So let's go to the chart and see if we can figure out what this guy is looking at or what he thinks is going to happen. So let me do this. Let me go to a daily chart first. And again, let's kind of blow this out because I like you guys to see this. So let's do this. Let's draw. I'm going to draw a horizontal line off the top here of these candles. And then normally what I would do in like an area of consolidation, I certainly see a lot of lows that are all lined up here around that 5240 area. I think that's a good valid area. But because we're on this Bollinger Band, what I'm going to do is I'm just going to draw my lower end. Maybe there's just maybe a little bit more room for Nike to fall down. So let's draw on the lower end on the outside of the Bollinger Band. And so let's see what, is it Mr. Shaw, right? Is that what his name is? What he's looking at. So here is a weekly. And if I go back in time, and let's turn off the Bollinger Bands. Let's do that. Let's go back in time, and then I'll go back to the weekly. What we do see is this current price range is falling into an area where we saw Nike trade for, what it was about 2.5 years. And it certainly looks like the origin of, one of the last big moves in Nike. So I think there's a lot of validity in what he's doing here. I think he knows that there's value in Nike. So how can we trade this, right? So do you want to follow him? So I think this is more about a rescue recovery story. I wouldn't think about this as something that's going to happen, overnight if I was going to buy Nike. So I would be looking at options, but I would not be looking in very short-term options. I'd be looking at some longer-term options. So again, this is a hypothetical, folks. And if I were going to do this, I would probably be looking at some leaps, some longer term options. And, let's give him the benefit of the doubt. Let's say it's going to take him about a year to turn this company around, get some clarity on, with tariffs and all that. So, maybe I would be looking at buying an in the money call. So right now you can see the in the money, the $50 call. We looked on the chart. That was kind of the low end of that range. So that's kind of our risk. It's trading around $11, $11.50. Now, I might wait and look for a little bit better price action. But, maybe, just above $10 or maybe, $10.50 or something like that. Again, let's go back to the chart. Think about this. If we are correct, well, let's go to the chart. Yes, let's go to the chart first, John. Yep. Stock chart. There we go. If we are right, and we're going to get time, we're going to get a lot of time, we're going to get a year, right? A breakout above $60 is what we need for this market to go higher. Now let's turn back on our Bollinger Bands. I'm going to change time frames here in a second, and I'm going to go back to daily, weekly. So a breakout above 60 would put us back inside the bands, and then you might get a mean reversion to 72, but maybe we might even get it to snap all the way back up to, where this recent high was, 89. And if we're wrong and Nike falls below $50, well, I still think you'll get some, and time value will still remain on that lead. Maybe only about $5, half of what it is now. But I think for a $5 risk for a potential, what, $12.50 reward to maybe a potential $20 reward, I think that would be a nice option trade to do if you believed in the value story.
Well, that's great, Johnny. I've been wanting to nibble at Nike, John, but every day I want to take a nibble, it's just down and down and down. So your analysis here sort of gives me a bit more confidence to maybe take a starter position there.
Well, remember what we talked about last week is that we wanted to look for buying opportunities, but we didn't have clarity in the market. We didn't want to invest in the market. We said that what we might want to do is we want to invest through options. And this would be a great opportunity, because if we're right and the market does rally, then we're in the money. So if we wanted to invest at that point, then all we have to do is exercise our options, right?
All right. Good call, John. Good call. All right, John. So we are going to be off next week. So it'll be a 2-week period. And there could still be volatility left in the market, John. I think, a lot of people are scared right now, John. They're watching their portfolios shrink. If you've got a 401k that you depend on, you're really scared. You're watching your values, the money that you need to live sort of, dissipate before your eyes. So, John, do you have any sort of final thoughts on where we are in the market, what to expect, what to do over these coming weeks and maybe even months?
Yeah, I think this is a good time to address volatility and uncertainty, right? We know markets hate uncertainty, and we have seen unprecedented volatility. Matter of fact, the intraday volatility right now is 5%. That means that we're seeing 5% moves from high to lows. That is just unbelievable, crazy. And I think this has only happened 3 times since 1979. That was in March of 2000, October of 2008, and November of 2008. And that's according to Dow Jones. So when markets have this type of historical volatility, it's probably, again, this is just my opinion, it's probably a good time to sit out and wait for greater clarity. Now, even seasoned pros like myself can get whipsawed, and I got whipsawed a couple times this day. But if you are going to trade, it's really important that you have a trade plan. And when I mean trade plans, I need you to have a plan to manage your risk. Now, the second part of this idea or thread of volatility is a concept called correlation 1. And that happens in extreme bear markets or dynamic downturns. Something called deleveraging or risk off or margin calls or whatever, or however you want to define it. This is when all assets fall together. And we saw this earlier in the week. Equities, oils, gold, treasuries, usually a safe haven, treasuries even fell in price. So from experience, Thomas, this tells me that somewhere, someone, or some fund blew up. And that, that could be a private fund or a public fund. My guess is we're going to hear it's going to be somewhere outside of the U.S., one of these European banks or something. And, it's going to take a while to hear this news, but I still believe there's another shoe to drop. Now, you don't have these types of swings in volatility without causing significant collateral damage and casualties. And there's always, and I mean always, somebody who thinks they are smarter or bigger than the market. And the market always finds a way to punish that disrespect. So just keep that in mind over the next couple of weeks.
All right. Good parting thoughts, John. John, we actually got a ton of questions today. Are you ready to jump into those?
I'm not ready for a ton of questions, but yeah.
All right. So the first question, John, very fortuitous because it's actually a question I wanted to ask you. How high can gold go?
Um, you know, I've kind of had this. I'm going to go to the GLD because it's whoops because we've been looking at the GLD as a trading apparatus. We've heard a lot of things about um, you know 3,200, 3,300, 3,500. But just a few weeks ago, we were saying, we had a little sell off in gold, and then I stuck to my guns. I felt that the GLD was going to get between 93 and 97, and here we are. We're right there. We're actually on the outside, on the other side of it. So my gut feeling, Thomas, is that this might be a blow off top. I mean, the dollar fell down below 100. If dollar continues to go below 100, then I think gold could go up, maybe another $100, $200. I don't know. Depends how weak the dollar gets. But I'm just going to be a little cautious here. Now, I had a game plan, and my game plan was when we got to this level, I was going to sell calls on the GLD that I own. And if my calls get exercised, and this is what I did, so be it. I'm going to make a nice little profit plus the call, the premium that I sold with the call. Because remember, volatility is super high, so call volatility is expensive. So it's going to be a nice trade. And if I'm right in this gut feeling, then maybe we get a little bit of a pullback, a temporary pull that back. And if I did get exercise, maybe I'll get a chance to buy back my GLD. But at this point, I think, we're probably closer to the top than we are to, say, the middle, if that makes sense.
Jim Van Meerten, John, bar chart contributor, he says we are at the bottom. There might be some volatility, but he looks to see the market bouncing off of current levels. How do you feel about that?
He believes that the stock market is
The stock market, yeah.
Yeah. Again, Jim, I don't want to put your words against you, but if you look at some of the metrics that you look like, we're pretty far away from getting some buy signals. And then Jim had a great article. I think it was today or yesterday. I would go into the news and look under chart a day. Was it today? Yeah, I think it was here 2 days yesterday. And I still think there's patience to be found. So, for me, I think for the S&P, for me to get bullish again, in the upside I think it would need to recapture that 5,700 level.
John, when looking at a candle pattern, how much weight do you put on volume for confirmation?
I put a lot. I think volume, is one of those indicators that a lot of people have forgotten. I think it's a forgotten art, and that is because I used to work in the pits, and you could hear the volume, you could feel the volume, you could see the volume, by the number of orders I had in my hands, and I knew that when I could hear it and see it and feel it, that was a very specific time or price point or whatever. Again, with algorithmic trading and enhanced, trading from retail traders, there is a lot of debate that maybe volume is not as significant, but I still believe that volume is very significant when you're doing candlestick analysis for sure.
John, today's the first time ever that we streamed to Instagram. We actually got a question from one of our Instagram users, and you're going to love it, John. If you're bullish on nat gas, what are your favorite stock tickers?
Well, I don't want to give a lot of, again, this is more like financial advice, but I will tell you that I am in two natural gas stocks in my personal portfolio. That's EQT and ET, Energy Transfer. But I think there's a lot of other great companies out there.
All right, let's see what we got. This is a good one. Trex Crude. John, what are your feelings about Occidental Petroleum right now?
I haven't looked at it. Have you looked at it in a while?
I mean, it's fallen apart just like crude has, so it's
yeah,
tough to separate the two.
I mean, who's been doing the best during this whole crisis?
Warren Buffett.
Yeah, and does he own it?
He does.
He does. Again, look at it. You got this huge Mariposa, and we're kind of, you know, I mean, this is an easy trade if you think about this. Let me do this in terms of this way. Um, there's your range of risk, right? One way or the other. And so I think, you just, if you're going to go into this stock and you want to buy it, you either wait for the breakout above this range or you buy here and you risk the low. So again, I mean, there's a lot of things I like about Accidental from the business that I know, but there's a lot of things I don't like about this chart, right? And one of them is what's one of my favorite um, expressions, Thomas, right?
Nothing good happens below the 200 day.
Yeah, and 200 days seems like miles away from where we currently are at.
This is a good question, John. The SPY, the S&P 500 SPY, the RSI is obviously greatly oversold, indicating oversold at the moment. John, would you use that to begin making your buying decisions, or do you need to use that in conjunction with other signals?
Yeah, I like it. Use it with other signals. I do rely on RSI for a lot of my technical analysis. If you are new to what's going on today, or you've been just starting to join us, look at our Wednesday webinars, and in our archives there, we have a webinar on RSI, and I really feel it's one of my best works. I really go in depth about how I use RSI. So one of the things, again, we talked about, there's a lot of noise on the chart. Don't look at the chart. Just look at the RSI down here. One of the things that happens in RSI in uptrends, the RSI will shift, and we usually will stay above 50%. It rarely will go below 40%. And on downtrends, well, the shift goes down. So it rarely gets above 60 or has a difficult time getting back above 50. So you can see that, yeah, we were extremely oversold, and that would have been a short-term buy signal. But for me, the clear sign would be to see the RSI on the daily level, and maybe even on the monthly level, to get above 50. But really, I would want to see it, and here it is. You can see right there, where did this sell-off start? And notice that our RSI here was struggling to get above 60. So for me, a bullish sign at this point for the RSI would be it getting it above 60.
John, one of our users wanted a little clarification, sort of on where you think the market is going. They're under the impression you think it's going to go up in the short term because of the God candle, and down in the long term because of Fibonacci's. Is that?
I think the market is going to have a lot of volatility. I just wanted to show you, we don't see a lot of Mariposos. And we had a historic one. I just wanted to show you how to use and trade that one. Yeah, I think in the short run, we probably could run to the top of the Mariposa. Again, that would, for where we are today, if I look at, the SPY, right, that's another, 15 points from where we are. So what's that? 150 or so points in the S&P index, maybe 200 points. So yeah, probably a little bit up higher here, but again, I still believe there's too much uncertainty in the market. So I'm still kind of in the wait and see. I don't really have a good sense of which way I think the market's going to go.
All right, one of our users, Jeff, John, he points out that we've got all this money on the sidelines. He says 6.5 trillion. I believe he's referring to money market monies that's in the money market funds. John, could that make its way over to equities if the equity market falls enough?
I think some of it, Jeff. I think some of that money could make its way, but there was a study that was done that who owns all of this money market funds, and a lot of the folks that own it was a very large percentage. I don't know. Do you remember, Thomas, when we looked at this? I think it was like 70, 75 or 80% of it is owned by, at the retail level, is owned by baby boomers and millennials, or not millennials, Gen Xers. And you have to think about where they are in their investment life cycle. And they're at the point where they don't need to take on risk anymore, right? They've been accumulated. And so this number has been rising for a couple of years now, and I really believe that money is not going to come out of the mutual fund market. Excuse me, the money market fund, because those folks want to be liquid, and they're very happy, right? Because up until 3 or 4 years ago, there was no other alternative in terms of short-term investing because interest rates were so low, part of that great experiment. But now they're getting 4.5, 5%. So they're very comfortable with that income stream. And because they want to be liquid, because they're at that part of their life where they want to start spending some of the money that they've saved for the last 25, 30, 40 years.
Yeah, and I think there could be a few people like me, John. Now, I don't have my money in money market funds, but I do have a little bit parked in 1 month U.S. Treasuries, and I have for a while just to collect. It's been over 4%. That's a pretty nice payout on a monthly basis, John. I absolutely. I mean, if the market falls low enough, John, especially if it gets to your target of maybe 4,200, I would absolutely deploy that capital into equities.
Right, but again, I think we'd have to go inside of that number and say, well, what percentage of the folks are like yourself, or right? And I don't know what that number is, but I think it's going to be a lot smaller than you actually think it is.
Agreed.
So maybe was it $1 trillion? Was it $6 trillion or something? I don't know. What's the number?
6.5. It might even be 7 trillion, honestly.
So let's say 20% could come back into the market. That's still a good number, right?
Yeah. John, do you have any thoughts on all these death crosses forming? So we had one in Bitcoin, we had one in NASDAQ earlier this week, and the SPX is on the verge of an imminent death cross. And any feelings there?
I think there's two theories I like. One is that I think that has a lot more significance when you see the death cross come as price starts to move through, let's say the 50-day and the 200-day. I think those ones are a lot more significant. When you see, let's say, a huge price fall and then the death cross comes, all that really is doing is confirming to you that you were or you are in a bear market. And again, in that scenario, what I would say my tactics for that particular equity or whatever asset class that I'm looking at would change, where I would be looking to sell rips and buy and not buy dips until price got, let's say, back to the 200-day moving average. Okay.
John, are you still a believer in international markets like Japan?
Yeah, I am. I do. I think Japan will be one of the first countries that'll be announced that is, we're going to go to a zero tariff or a very low tariff market. They're already building a lot of their cars already in the U.S. I just think we want more access to their agricultural market. So I think that's gonna happen. Plus, I still believe that Japan's economy is doing a little bit better than, let's say, some of the other places around the globe. And that's kind of reflected in their seeing a continuing rise in inflation. That's usually a good sign. So yeah, I'm still pretty positive. Now, I'll be honest, I did trim my position a little bit in my Japanese ETF, only because I had to stick to my risk management rules. But let's say I have a third of it I trimmed. I took a little bit of a hit on, but I'm still feeling very confident about it.
So we got a question from one of our ex-users, John, and he wants to know, do you think the Fed will cut interest rates this summer? Now, John, before you answer, I pulled up CME FedWatch. The market is currently giving a 76% chance of at least a 25 bips interest rate cut at the June meeting. John, do you think that's the likely scenario, or would you take the opposite side there?
I mean, I think coming into the beginning of the year, I really kind of felt that we weren't going to see any cuts, or maybe just one cut. I did notice some of the inflation numbers have come down. I would be interested to see what the inflation numbers do moving forward. Let's see what happens with energies, right? A lot of agricultures have fallen back. Let's see what happens when tariffs start to really be implemented, because I think that will eventually put inflation back on the upswing. So, you know, if they're looking for a very small window or an opportunity to make one cut this year, it would probably be that window, because I really do feel that between June and the end of the year, you're going to start seeing um, inflation tick back up again, especially if we have any type of tariff activity.
John, I put this out in the Twitter account last night. Dixie, the U.S. dollar index, it fell below 100 for the first time since July 2023. And if you look at the chart, it's just been a huge plunge downward. Do you feel like that has a lot more legs, or do you think we're getting close to the end of the pain there?
I think in the short run, I think it's probably a little oversold. You can see how far we are outside the Bollinger Bands. But again, notice the bands have turned out. That's usually a sign of continued volatility. We did kind of looks like we did already done some analysis around here. So we did get a probe down below here. Um, yeah, I think, again, trend your friend until the bend of the end. I think this is a downtrending market, but we are in a historical range of around a 100. So yeah, I think my idea would be probably a little bit of a short term bounce, but I would not. Whoops. Let's look at this in a bigger picture. I would not be surprised if we get down to like that 97.50, 95 level. But again, I don't think this is going to happen overnight, because we've gotten too far too fast to the downside. This might be something we could look for towards the end of the year. And again, you're talking about gold. This could be your catalyst to push gold up to, I don't know, 3,300 or 3,500. I don't know. But in the short term, I think probably a little bit of a bounce from here.
All right, we're going to take one more, John, and it's only because it's from Wayne. Long time. He comes every week. Wayne, thanks for coming.
Hey, Wayne, how's it going, buddy?
So Wayne wants to know, John, if Jim Van Meerten is right and stocks are ready to rally, is that going to hurt gold and gold miner stocks?
Well, I certainly think that the portfolio allocation, a lot of people have probably gotten into gold as a safe haven. So I think that could tell me that money could come out of gold and go into the equity market. So that would be a yes. Again, you would have to have a stabilization of whatever uncertainty we're having, and again, that could be a sign for the dollar to rise. Again, a headwind for gold. So Wayne, I think there's a lot of positives that would need to happen for the stock market, could be negatives for gold. But I also do believe that gold and the equities market are more positively correlated than they are inversely correlated. So, a strong stock market could be actually a good sign for the gold market, though.
All right. So next week, John, Friday is Good Friday. So we're going to take the week off. We've done 6 consecutive weeks. I think we need a break, John, clear our heads a little bit. We'll come back fresh the week after. But John, here's the last question for you today. Do you have anything fun planned for your week off?
Tomorrow is mulch day, but you can see it is the Masters, and I think the Masters is one of the greatest golf tournaments or sporting events. So I will be looking forward to watching that on Sunday.
Perfect. I think I saw Rory McIlroy's having a heck of a start. He's in the running, and a lot of people had picked Rory to make his comeback and finally get that green jacket.
I met Justin Rose a few years back, and he was a perfect gentleman. So I'm kind of rooting for him, because he's been there a couple times and faltered. So maybe this is his year.
All right. Let's see how it shakes out.
All right, folks. I hope you guys enjoyed. Those of you watched on Instagram, come and check us out on X. Check us out on our Bar Chart YouTube channel, and come check us out at barchart.com. And I think you'll find a lot of great tools and features to help you make some more informed decision making. Until next time, in a couple of weeks, best of health, manage your risk, and the good of all trading.